Hello, and welcome to this financial analysis lesson, which will focus on ratios and key performance indicators. After you have finished this lesson, you will be able to, firstly, recognize the different types of ratio as indicators of financial performance. Secondly, interpret ratios using trend analysis and identify where action needs to be taken. Thirdly, conduct supporting analysis to gain a deeper understanding of the performance. And fourthly, check your understanding with a simple exercise. To begin with, let's look at the different categories and types of ratio. Ratio analysis is a way of assessing an organization's year-on-year performance, assessing performance against targets, and a way of benchmarking performance against that of competitors. Hence, there are different categories of ratios which will help us with this performance assessment. Firstly, profitability ratios, such as return on capital employed and sales margin, measure how effectively an organization is employing the capital entrusted to it by its shareholders and other lenders. Secondly, working capital ratios, such as inventory days, show how the organization is managing its working capital. Thirdly, liquidity ratios, such as the current ratio and the quick ratio, measure how well an organization is placed to meet its short-term financial obligations. And fourthly, solvency ratios, such as the gearing ratio, measure how well an organization is placed to meet its longer-term financial obligations. Let's now consider each category in more detail. Let's start with the key indicators of profitability. Firstly, return on capital employed, or ROCE, measures the profitability of an organization's operations and assesses the extent to which an organization is achieving a return on its long-term capital. The ratio must be sufficient to enable the organization to meet its obligations and provide for future growth. Secondly, sales margin measures how much operating profit has been generated from each dollar of sales and assesses whether operating margins are improving or declining. If operating margins are being squeezed, it can prompt management to either raise selling prices or reduce operating costs, or both. Thirdly, gross margin measures how much profit has been generated from each dollar of sales, before considering indirect costs, and assesses whether direct costs are being controlled. Fourthly, asset turnover measures the productive use of assets in generating sales, and assesses the extent to which assets are being usefully employed or are underutilized. An adverse movement in the ratio may suggest that assets are being underutilized. And fifthly, return on equity measures the return on shareholders' equity and assesses the extent to which an organization is achieving a return on the capital invested by its shareholders. Next up are the key indicators of working capital. Firstly, inventory days measure how many days on average an organization's products are in the warehouse and assesses how much cash is tied up in inventory. Ideally, this ratio needs to be relatively low, but driving them down too low may be detrimental, as the holding of inventory may play a significant role in attracting customers. If inventory days are too long, it may be necessary to reduce inventory and free up cash. The key is to strike the right balance. Secondly, receivables days measure how many days on average it takes to receive monies from customers and assesses how much cash is tied up with customers. Ideally, this ratio needs to be low, but the provision of credit terms to customers may be necessary to seal the deal. And thirdly, payables days measures how many days on average it takes to pay suppliers and assesses how much of an organization's supplier's cash has been tied up. Ideally, this ratio needs to be relatively high. However, it is important that payments are made within the agreed terms. This slide shows a summary of the key indicators of liquidity. Firstly, the current ratio appraises an organization's ability to pay back its short-term liabilities with its short-term assets and assesses an organization's financial health. A figure above 1 indicates reasonable ability, and a low figure suggests an organization may be unable to pay its bills in the future. And secondly, the quick ratio is a more rigorous assessment of an organization's ability to pay its short-term liabilities. Even if most of an organization's inventory is in the form of finished goods, there is no guarantee that there is a demand for it, and therefore no certainty how long it will take to be converted into cash. The quick ratio gets around this problem by deducting inventory from current assets. As such, this ratio is good to use to assess an organization's financial health when its inventory is large and difficult to convert into cash. And our last category of ratios relates to solvency. Firstly, the gearing ratio compares an organization's external funding with that invested in it by its shareholders. A relatively low ratio is desirable, as this will provide scope for further borrowing if required. And a high gearing ratio may cause problems if an organization experiences a decline in demand for its goods or services. However, a low gearing ratio may not necessarily be to an organization's advantage. A reluctance to borrow may result in the organization missing out on investment opportunities. Secondly, the debt-to-assets ratio is less commonly used than the gearing ratio, but substitutes total assets for equity in its calculation. It measures to what extent an organization's borrowings are covered by the book value of its assets, and assesses whether the level of debt is reasonable in relation to the value of an organization's assets. A lender would therefore be more comfortable with a low ratio. And thirdly, the interest cover ratio indicates how well placed an organization is to meet interest payments on borrowings and assesses an organization's ability to meet interest payments. A lender would therefore like to see as high a ratio as possible. Now, let's look at how to interpret the different types of ratio and identify where action needs to be taken. Ratio analysis is a starting point for any in-depth evaluation of an organization's financial performance. For an analysis to be meaningful, it should be based on 3 to 5 financial periods, so that the key trends can be identified. This way, you can identify where there might be cause for concern or a need for further investigation. For example, economic conditions may have been unfavorable, or there could have been exceptional increases in operating costs, or a competitor may have instigated a price war, which adversely impacted financial performance. If you look at the table on the slide, what can you learn from it? The key trends are shown on the right of the table. For example, why is it taking longer to receive payments from customers? Further investigation could reveal that the organization's payment collection processes need tightening, or that extended payment terms are being granted as part of the sales package to attract customers. And why are the liquidity and solvency ratios worsening? The quick ratio is particularly worrying, as it has fallen below 1, indicating potential cash flow problems. And with the gearing ratio approaching 1, this might suggest that there is little or no scope for additional borrowing. In summary, although the organization is increasingly profitable, it could be forced out of business as it lacks cash and access to cash, based on both the quick and gearing ratios. You can also conduct ratio analysis to benchmark your organization's performance against competitors. If you look at the table on the slide, it shows ratios for 3 organizations operating in the automotive sector. Note, it is always preferable to benchmark against more than one competitor to avoid the wrong conclusions being reached. From the data, we can see that the relatively high ROCE for Company C tells us it is making more productive use of assets than the other two companies. However, this may camouflage a problem. The assets may be approaching the end of their productive life. If so, they will have been heavily depreciated on the balance sheet. A reduced asset value means less capital employed and a potentially misleading increase in the asset turnover ratio. Further investigation would reveal the key reasons. And trends in the payable days, liquidity, and gearing ratios indicate these are possibly interrelated. High payables leads to high current liabilities, which in turn leads to a low current ratio and low quick ratio. The organization may face potential cash flow problems and the need to take on more debt, as evidenced by the higher gearing ratio. In summary, although Company C is profitable, it is very dependent on the continuous support of its suppliers and lenders. When interpreting ratios, ensure you benchmark comparable organizations for reasonable comparisons, as organizations at different stages of business growth will have very different ratio results. For example, an early stage or fast growth organization is likely to have high payable days, as it makes full use of supplier credit terms to aid cash flow, whereas a mature organization will likely have low payable days, as the organization will have a positive cash flow and will not be dependent on supplier credit. And a fast growth organization is likely to be highly geared with high debt to fund growth ambitions, whereas a mature organization is likely to be low geared, as there will be less need to borrow debt. Now let's look at some supporting analysis to gain a deeper understanding of an organization's performance. There are different categories of supporting analysis. Firstly, segmental analysis is a way of drilling down into figures from the primary financial statements to gain a better understanding of an organization's underlying performance. Secondly, contribution analysis is a useful starting point for decision-making in multi-product or multi-service organizations. And thirdly, the Pont ratio matrix is an overview of a method for breaking down return on equity. Let's now consider each category in more detail. Segmental analysis is used to drill down into figures from the main financial statements to gain a better understanding of the organization's underlying performance. For example, turnover may be classified by product category or geographical market. Consider what the data is telling you, which products and regions are accounting for the most revenue. When conducting segmental analysis, to make the analysis meaningful, you need to compare figures with the previous reporting period. Again, consider what the data is telling you. Which products and regions are growing or decline revenue? What has driven any changes in the sales mix? Why are there changes in the regional makeup of sales? Further investigation may reveal differences in terms of business models, such as pricing or production costs. Also consider what additional information would be useful to you, such as the gross profit contribution, which we will look at next. Gross profit contribution analysis is a way of assessing relative profitability in a multi-product or multi-service business. As well as establishing which products or services are the most profitable, you can analyze where variable costs can be reduced to increase net income. The metric can be used as a ranking tool when there is an output-related constraint, such as a machinery breakdown or a scarcity of input materials to maximize the organization's profitability. For example, in the table on the slide, product D has the highest contribution margin, which might suggest that the organization should give priority to this product. However, This should only be the starting point for decision-making. There may be strategic or commercial reasons why other products should take priority. The DuPont ratio matrix breaks down return on equity into 3 distinct elements. By breaking down the returns that investors receive from an organization, you can drill down and determine which of the elements are dominant in any change of ROE and identify areas of underperformance. For example, an organization could generate an acceptable ROE by being high margin, such as fashion or high-end cars. For such organizations, increasing sales without sacrificing margin is likely to be critical. Or an organization could be in a high turnover industry, such as certain retail stores, selling a significant multiple of their assets per year, and may have very low profit margins on sales and relatively moderate leverage. The ROE of such organizations may be particularly dependent on performance of this metric, and hence asset turnover may be studied extremely carefully for signs of under or overperformance. Alternatively, an organization could rely on high leverage to generate an acceptable ROE, for example, the financial sector. One of the advantages of the DuPont matrix is its structure, which integrates financial measures with operational indicators. By contrast, a drawback is that it is short-term oriented. Let's now do a quick check of what you have learned. Please review the short case study on the slide and calculate the 3 KPIs. The answers are on the next slide. For the ROCE, which is calculated by operating profit over capital employed, you can take $800 million over $4.3 billion, giving a ROCE of 19%. Note how there are 2 ways of calculating the capital employed, as shown in the slide. For the quick ratio, which is the current assets minus inventory over current liabilities, you can take $500 million over $800 million, giving a ratio of 0.63 to 1. And finally, for the gearing ratio, which is long-term debt over equity, you can take $1.4 billion over $2.9 billion, giving a ratio of 0.48 to 1. In summary, when using KPIs in your financial analysis, be aware of the different categories of KPIs and how they can be used to assess financial performance. Take time to interpret ratios using trend analysis and identify where action needs to be taken, and use supporting analysis to gain a deeper understanding of the performance. To make your analysis more meaningful, compare performance with other similar organizations in the same industry and at the same stage of growth. Thank you for participating, and see you next time on another exciting business training lesson from Pont.